Thank you so much. Good morning, everyone. We are so pleased to have you here with us today as we launch our 6th month, if you can believe it, of Business Over Breakfast with Emory Executive Education at Goizueta Business School. So we're so grateful to all of you who have joined us along the way, and welcome to anyone who is joining us for the first time. My name is Sarah Gill. I am Director of Open Enrollment, which is our programs for individuals with Emory Executive Education. This month, September, our series is going to be focused on skills for a COVID world. So we're kicking off today with a look at the economy, followed by strategies for used to manage uncertainty, and then a look at conscious leadership for stressful times through the lens of emotional intelligence. And finally, experimenting your way to innovative growth. So some really interesting topics. As I mentioned, this is our 6th month of the series. So we launched Business Over Breakfast back in April, really just with the goal of being a source of information and ideas during uncertain times. And we've been thrilled that it's been a valuable resource for many of you along the way. So you may recognize our guide for today's webinar, especially if you joined us back in April. Tom Smith, professor in the practice of finance, has had appearances on CNN, NPR, Huffington Post. So you may recognize him from there or just by his super unique name. Tom is considered an expert in the area of labor economics, pricing, sports economics and finance, the economics of the entertainment industry, and the economics of the healthcare industry and film finance. He teaches in a number of our executive education courses, including some that are coming up very soon, and we'll share some information at the end today, but we have our personal financial fitness workshop starting on October 2nd, as well as finance and accounting for non-financial managers starting in December. So Tom will spend around 30 minutes today focused on the economic news, what it means for you, followed by 30 minutes of Q&A. So please know that you can write your questions for today's session in the Q&A box at the bottom of your screen at any time. And our team, including myself and my colleague Lauren, will do our best to get as many of your questions answered today as we can. At the end of today's session, there will be a short 5-question survey. So we hope you'll fill that out just to give us feedback on how we're doing. So in the meantime, please enjoy the morning with Tom, and we look forward to continuing the conversation around skills for a COVID world with you for the rest of September. Over to you, Tom.
All right. Okay. I'm going to shift it over to, hold on a second, shift it over to a couple documents here. I'm going to start with some very basic stuff and then move to maybe some more economic indicators. Let me start by talking a little bit about some of the things that are changing with respect to policymakers. Very, very big announcement came out last week from the Fed chair that the Fed was reevaluating their role in policymaking and changing some of their targets. Probably in the last 10 years, you probably know more about Fed policy because people have talked about it quite extensively. The Fed has typically targeted this 2% inflation rate, what people call the Taylor rule. And as you start seeing inflation go above 2%, then the Federal Reserve would increase Federal Reserve Fund target rates to try to push inflation back down. Well, last week, the Fed announced that they're no longer going to be targeting this 2% inflation in the short run, understanding that they could have prolonged periods of inflation less than 2%, which would then push them into policies where they're saying what we want to do is maybe encourage some inflationary tendencies over some short run periods. So essentially, this means that the Federal Reserve will keep interest rates lower for longer, right, which is going to encourage banks to loan. There's a number of other policies that the Fed has been engaging in that are very unique. The Fed is purchasing all types of assets that they haven't purchased in the past, except for some very particularly timed policies, let's say TARP, Troubled Asset Relief Program, that was instituted back in the 2009, during the 2009 recession, where the Fed teamed up with the Treasury. The Fed has been engaging in lots of purchases of assets to create liquidity for the market, and it looks like they're going to continue to do that. The Fed has been buying corporate bonds. They've been buying basically everything that everybody is selling. At the time, doesn't seem to be impacting anybody, but it has left some macroeconomists wondering essentially if this is a sort of a change in general monetary theory, in that the Fed is now essentially going to create liquidity for private companies as well as the US government. So this doesn't seem like it's a big change, but it's a really big change because what's happening is the Fed is saying that they've been given permission themselves to keep interest rates lower for longer, right? So they're trying to make sure that they can, let's say, keep a recession from happening in the future by perhaps keeping uh, keeping economic growth going on for longer. So it's a pretty big change. Um, you're probably aware that the president signed some executive orders a couple of weeks ago, and these executive orders included an unemployment benefit of $400 from FEMA, so the emergency money that's guaranteed through FEMA. So because of the way that this executive order was written, and because it now falls on the states to actually engage this little policy, we have gone from $400 to essentially $300, right? And then their states have to essentially set up a system that would allow them to release this additional $300 to people who are filing unemployment claims. So these are the states, all but basically two states have said that they are not going to apply for this, right? So these two states here, the Dakotas, one of them says, look, we're not even going to try for this. The other one hasn't applied yet. Illinois has just recently applied, but they haven't been approved. Every other state has been approved to actually release this $300. Okay. And the benefit, you'll notice though, by state is actually 300 rather than the 400. Okay. So a couple states are going to pony up an additional $100. So they're getting $300 from FEMA, and then they have to add $100 themselves. That is, the state does. Well, the states don't have money. Most states don't have this kind of money. So what's happening is that they're just going to rely on the FEMA dollars to provide the $300. Only a handful of states, literally 1, 2, 3, 4, 5 states, are adding in the additional $100, right? And then, right, South Dakota is not. They're not going to deliver any of this money, right? But so they say, like, okay, so most every state has been approved, and most every state is going to give $300. Well, actually, most states haven't actually started rolling this money out to unemployed persons. Okay. So again, only a handful of states, 1, 2, 3, 4, 5, 6, have actually started releasing this money to unemployed persons. Okay. Another handful of states are supposed to start releasing this money by the middle of this month. And then a handful of states are supposed to start in October. But you'll notice that there's a huge number of states that, even though they've been approved, they don't know when they're going to actually start rolling out these benefits. Okay. So these benefits it's not nothing. Clearly, people who are unemployed could use additional $300. That much is true. But when they're actually going to get the hands on these funds is to be determined. The states are doing their best to try to figure out how it is that they can push these funds to the people who need them, but most states have to reconfigure their system in order to actually make this possible. Okay. In addition, the way that the law, it's not a law, it's an executive order. The way that the executive order was written is you're only eligible for this if you were receiving at least $100 in state unemployment benefits the previous week, which means that there's a fair number of people who aren't going to be eligible right now for these benefits, and then they might not be eligible for these benefits in the future. So it is a real Band-Aid instead of a thorough policy. It's not to say that it isn't a helpful Band-Aid. Certainly it is. Sorry, the sun is like all of a sudden it's just peaked up over the horizon here in my backyard. Sorry about that. So it certainly is a helpful Band-Aid, but it is just a Band-Aid. Now, Congress and Senate are working on a fiscal stimulus, and I'm sure that you've read about this and about the back and forth. I think the Democrats have put together a package that's maybe a couple, 3 trillion, and Trump has signaled that he's interested in signing something along the lines of maybe 1.3 trillion. Whether they will come together with something in the neighborhood of 2 trillion or 1.6 trillion, it's to be determined as well. So I am not as hopeful about that. So in the absence of that, this executive order seems to be the only path forward for creating some additional unemployment insurance money for people who are unemployed. However, the rollout is not as smooth as maybe the economy needs, and some people aren't going to see money for maybe another month or 2 months, depending on how it is they can put their systems together. In terms of the current state of the economy, there is some sort of better news than worse news today. Okay, right? And Chris, yes, this is $300 a month. Um, but it's not. I mean, it's supposed to be $400, but it really depends on what the state can actually pony up, right? And so you can find the executive order, and you can parse it out, but it looks like the states are only going to be able to provide the 300 of that because they don't have the extra money for the additional $100. So it's looking like $300. Okay, and it's not clear that it's actually a month. It's more, so it's supposed to be per unemployment check, which might include like you're being paid every other week, right? So but it might be $300 a month. It might, I mean, the states have a lot of flexibility with respect to how it is they're going to roll this thing out and how much they get to pay. So FEMA has money, but their money's going to run out. It's hurricane season. We've got some issues with respect to like how long that policy could have. Okay. How have the unemployment rates changed? Well, so this is where I said we've got some sort of good news and sort of okayish news. The okayish news is that the new unemployment insurance claims were only $900,000. 900,000 workers this last week. So it went down. It had been hovering around 1.1 million new persons filing initial unemployment claims. Now that's at 881,000. You would say this is great news. Actually, even at that number, it is so unbelievably high, right? We didn't experience anything of this magnitude in the 2008 and 2009 recession. So, the initial unemployment claims went up a little bit last week, right? Went from just around 1 million up to 1.1 million. And then this week, that is this Thursday, we're reporting for last week, they went down to 881,000 new initial unemployment claims. The projected unemployment rate, which is going to be released tomorrow for last month, is probably going to be about 9.8%, 9.6%. But a lot of this has to do with whether or not people who are unemployed, right? Because in order to be unemployed, you have to be officially looking for work, right? You have to not have a job, and you have to be looking for work. But the number of people who are actually looking for work is starting to fall off quite dramatically given the schooling situation. Let me share with you this, please. I'm apologizing for the system today is acting a little bit squirrely. And so let me show you this. It turns out that that there has been quite a dramatic change for the number of people who are actually working and in the labor force. And as a result, the number of persons unemployed and or the unemployment rate is going to be not exactly telling with respect to who has jobs and who doesn't have jobs. Okay, so like here's a unemployment rate by group by month. Okay, and so even though the national unemployment rate is at 10.2% for August, or excuse me, for July, right, the unemployment rate for different groups over this time period is dramatically different, right? And so you take a national average of these things, you're getting 10.2%. But you can see that for some groups, their unemployment rates are considerably higher than for other groups. Women in particular have a significantly higher unemployment rate than men, pretty much across the spectrum. And women are actually leaving the labor force much greater rates than men. So here's the labor force participation rate of men and women. These bottom two lines here, the labor force participation rate of men and labor force participation rate of women, right here, right? So these top lines right here, labor force participation rate of men, okay, is about it was at 86%, and it fell quite dramatically during the start of our pandemic, and now it has rebounded to about 80%. The labor force participation rate of women, which was at 75%, has fallen down. It fell all the way down to 63%. Now it's gone back up to about 68%. So women, by and large, are taking on the responsibilities, I think, of basically becoming homeschool teachers, right? And so the number of persons who are unemployed isn't exactly consistent with the number of people who do not have jobs. And that is problematic. So you say, okay, well, the unemployment rate is going down, so everything is terrific, right? Not exactly. A lot of the people who would be considered unemployed are saying, look, I've got to help my third grader figure out how to do, long division. So I just don't have the time and energy resources to go back and find employment. I'm going to stay out of the labor force. And as they stay out of the labor force, now they're no longer counted as unemployed. The fear is that from my perspective and the perspective of a lot of other economists is that when the economy does start to pick up, and all these women now start to enter back into the workforce. We send kids back to school, thank goodness, and women start entering back into the workforce. Will there be enough jobs to actually support this part of the population? And so could you get this huge spike in unemployment? Things could change quite dramatically. And so even though unemployment rate is falling, I don't think it's telling the complete story. All right. We did see a dramatic drop in GDP, one of the largest drops in quarterly GDP that we've ever experienced. I think that for the upcoming quarter, our drops in GDP are not going to be as dramatic. We've seen lots of states reopen, even though we have some states, California, that is sort of like an accordion. They're going from reopening to closing again, back to reopening, back to closing. So it's creating lots of headaches in California with respect to businesses trying to reopen. Other states are trying to roll out policies that are making it easier and easier and easier for businesses to reopen. But what we're still seeing is that the lack of, let's say, cash flow and the lack of consumers going out and spending is still having this huge impact on businesses being able to stay open. And so we're seeing still a very large number of businesses filing for bankruptcy and or going out of business. So Steinmart, this place my wife loves to shop, they're going out of business. Okay, other companies are going out of business. And so the economic landscape 6 months from now, 9 months from now, is not going to include a lot of the stores that, let's say, you enjoy spending your money. So what it means is that, let's say, as the economy starts to recover, and I made this point over and over again, that the economic recovery is really hinged on finding some kind of a pharmaceutical intervention for COVID. As the economy starts to recover, once we have a vaccine and once we have some other kind of a pharmacological solution, there's not going to be the stores there available to hire people back, right? Big box stores are going out of business. Restaurants, huge number of restaurants going out of business. Movie theaters are probably going out of business. And where are people going to work? That's very, very problematic. There are some industries where we're seeing an uptick in employment, right? Your Amazon fulfillment centers and things of this nature. But Are there enough of them to keep everybody employed? I don't think so. We still have very, very high unemployment rates. What else do I want to talk about? I don't know. I'm curious if there are any questions out there, actually. It's about 20
Yes,
minutes.
yes, Tom. Yeah, we've got a few questions here. Thank you. So let's see. So one question was just, how have unemployment rates changed over the past weeks, and have they improved?
Well, I mean, like I mentioned, the unemployment rate is continuing to be quite high. I suppose it's all relative, right? And so we saw week after week after week after week of people, a million people applying for new unemployment claims. A large number of those people have gone back to work in some capacity. So there is a decrease in the unemployment rate, how the BLS measures it, but there's also a significant change in the way that people are working. So what we're finding is that people were lost a full-time job and now they've gone back to some kind of a part-time job, right? They lost a part-time job and they've gone back to something that's significantly less than part-time, right? So the unemployment rate is not telling the full story. You're still unemployed, right? Or now you've gotten your job back, you've gotten a job, but the job is dramatically different than what you were doing before. So it may be fewer hours worked, and it certainly is going to be for less compensation. I know there's 175 people listening here. I would gather that 90% of you either have taken a pay cut, some kind of a cut of your own pay, or somebody who has taken a pay cut. And so that's a decrease in wages, right, which is always associated with an economic recession. That decrease in wages is going to have a negative impact on our real GDP. And we saw it last quarter. I mean, one of the largest drops in real GDP in history. And so we are facing a very troubling circumstance. Fewer people working, people who are working are taking pay cuts. People who are becoming reemployed are becoming reemployed with significantly lower hours. And so even though parts of the economy look like they're moving in a better direction, it's not a replacement. They're not saying, okay, so fine, I was out with a job and now I've got a job again. Well, now you've got a part of a job again, right? Oh, you didn't have an employment, you didn't have a wage. Well, now you have a wage again. Yeah, but it's only a portion of the wage that you were earning before. So it's not 100% fix.
A number of
Yeah.
questions are pouring in actually. So to combine a couple, has Georgia approved the payments that you were referencing earlier? And what is your best forecast for 2021?
Yeah, so Georgia is one of the states. There's only two states that haven't been approved for the executive order payments through the FEMA. So Trump is tapping these FEMA dollars that are available for emergencies, and so that's where that additional unemployment money is coming from. Georgia has been approved. It's not clear when Georgia is actually going to start delivering those dollars, because Georgia has to reinitiate their entire unemployment system to identify who's eligible and then create a new system in which they can pay these persons. This is unlike the bill that was passed and the fiscal stimulus package that was passed, because then Congress, they can approve these payments and say, okay, here's money. And so they give it to the treasury and say, here you go, like go and dole it out to people. All right. Well, this is not that. This is sort of bottom up. Like, okay, you got to figure out how your system can create this $300 payments. You have to tap into it, create a system that you can allocate it. So, but Georgia's been approved. We're just now waiting to see when it is that they can roll this thing out. What was the second question? I'm sorry.
The second question was, what is your best forecast for 2021?
Right. Well, the economic forecast really hinges on the ability for the United States to find a pharmacological solution, right? Either a vaccine or some combination of vaccine and current current drugs that can either prevent people from getting COVID or can significantly reduce the effects of COVID. Right? This is just like every economic recession. Our economic recession is caused by an economic shock. And in the past, in order to cure the economic recession, you first have to address the economic shock, right? With the 2008 and 2009, the economic shock was a meltdown of the housing industry and the way that banks were lending to individual lenders. And so those banks went out of business. A lot of them did. You had to come up with solutions. Banks had all these assets on their balance sheets, and so we had to create these programs to essentially rid the economy of all of that jazz in order to start making a comeback. And as you're probably aware, the comeback was really slow. It took us a long time to get out of that economic recession. This economic recession is caused by the pandemic. Okay, there may have been some over leveraging. There may have been some parts of the market that were not running completely efficiently. But aside from that, a lot of people had really strong outlooks for where the economy was going. Well, the pandemic changed that clearly. So now we're talking about people aren't working, or kids are at home studying, English because they can't go to school because of the pandemic. Well, we cannot fix the economy until we fix that aspect. If we can come up with a solution by early 2020, then you have to mass produce this drug, and then you have to vaccinate a lot of people. That's going to take a lot of planning and a lot of time, right? So if everything goes well, maybe we're talking end of first quarter, beginning of second quarter, probably not until the beginning of the second quarter or end of second quarter where we're going to start to chug along like we were prior to the pandemic. I know that's not probably the prognosis that you'd like to hear, but I think it's realistic to think that we're going to just kind of nudge along for the next maybe 12 months, at least 9 months, but maybe 12 months until we have some kind of a vaccine. And if we can get a vaccine, and then people can get back to school and people can get back to work. Well, we still have the problem of the fact that Steinmart's not open and Hertz is out of business, and pick and choose which companies don't exist anymore, right? You go to work for Amazon or Disney, that's great. But until then, who's going to employ you? Those companies don't have cash flows. They're going to go out of business. And that's what we're seeing.
Thank you, Tom. Lots of great questions coming in. Next one is, are we seeing people move out of large cities in search of lower cost living, or in part due to more flexible remote working options?
Yeah, I think it's actually more of a function of flexibility with respect to where they are working or where they're not working. And so I've talked to quite a number of colleagues who are moving out of California, are saying, look, I was here because this is where my business was. Now I don't actually have to be here for my business. I think we're thinking about moving back to Houston. Or I think we're thinking about moving back to New Jersey, or we're going to move back to Atlanta. So people are definitely making different types of choices now that they're not tied or chained to an office. And probably a half dozen companies that I've talked to just in the last week about what their future plans are. 4 of those 6 companies that I talked to are not going to have either completely bought out their lease, or are not going to renew their leases, or have renegotiated their lease to move into a much smaller space, almost literally just like a coat rack. And so the idea that companies, when the economy starts back up again, that companies are going to say, fine, now the office is back open, come on in, work the office, 5 days a week or what have you. I don't think that's going to be the same. What we saw before is going to be the same going forward. So I can see a lot of companies are going to say, no, you know what? There's a lot of inefficiencies with respect to remote working, but we just can't, let's say, afford that $10,000, $15,000, $12,000 a month rent payment on this huge space. So we were able to work without it. I think we're going to try to make it work without it going forward. And a lot of businesses are staying open by not, by renegotiating those leases and by moving out of those spaces. But I think a lot of companies are not going to have those spaces going forward, which means that people have a whole lot more flexibility in where they live and how they live. And so once you take away some of those ties, right? You have to commute X number of minutes or hours to your job. Well, that frees up all types of possibilities for where you can work. And so, I mean, if it was safe, I mean, people would work all over the place, right? Everybody's going to move to the Bahamas, or everybody's going to move to Cancun and say, I can work from here, right? It's beautiful. So, yeah, people are changing because the situation is changing.
Thank you, Tom. Another question for you is, what are the bright spots in terms of industries or sectors, apart from the obvious ones like healthcare, biotech, basic consumer goods? Who is doing well?
You're looking for like some kind of like secret here. Well, I mean, so the industries that you've mentioned are in fact doing pretty well. Information technology and other kinds of information services are doing okay, but they're not doing maybe across the board as well as we would think. We're actually seeing some pretty significant changes in employment in those industries as well. Here, I'm going to share something with you here, put together with one of my colleagues. I got to do a shout out to Bill. He's my man here. This is current levels of employment. This is for Sandy Springs, the metropolitan area, and you'll notice. I mean, these are a couple of months in arrears, but that's just because of the way that the data comes in. Okay, so we're seeing dramatic changes in some industries right here, like manufacturing. We saw 12%, 10%, 7% decreases in employment. These are year over year changes. Okay, but look at this information, right? You say like, oh, they've got to be doing well, right? Well, actually, they've seen more recently some very, very large changes in employment, down 10% from where they were previously, right? Professional businesses and services, right? Down 6% from where they were a year ago, okay? Education and healthcare services, as you mentioned, right? So the employment there is only down, let's say, 0.8%. So they are doing better relative to other places. Clearly, leisure and hospitality, they're doing very, very poorly. Government is actually not doing as bad. So, I mean, you might not think the government works very well, but they need people to work because they need to get stuff done. People are relying on the government a whole lot more than they have in the past, right? For unemployment insurance claims, for other types of assistance with evictions and things of this nature. I mean, people are really pressing the government to help them out. And so, I mean, the government sector is actually doing well. If you want to get a job, you can probably get a job in the government. But it's not clear that there are, let's say, some sectors that are just doing so much better than other sectors. What's interesting is that there's some sectors that you say like, so here, right? Some of these like total non-farm is way down. Mining and lodging is down by 6%, but construction is only down by 2.4%. So not all construction projects have completely halted, right? And people still have capital in the mix. They still say, okay, I want to have this thing completed, right? The industries that I'm seeing as being, let's say, people are really pushing forward have to do with, let's say, home repair. And so this is a warning to some of y'all who are thinking about having things like your fences fixed or what have you. There's been surge pricing on lumber. So there is a shortage on pressure treated lumber because so many people are staying home and doing new projects. Well, it's probably going to cost you about 30% more to have a fence built, to have somebody come in and maybe frame out your basement than it would have, even 6 months ago. And so work in the construction trades, general contracting, somebody being a handyman, actually these industries are probably doing fairly well. So if people have money, and we're seeing saving rates actually go up. So you can probably think for yourself about how many ways you're not spending money that you would have. Well, a lot of people are taking those savings and saying, okay, I got to work at home. So let me maybe I should now finally finish the basement. Oh, yeah. You know what? I've been thinking about making some improvements to master bath, so maybe it's the time to be doing this. The yard, I'm going to spending some time in the yard. Let's redo that fence, or let's build a raised garden or something. Well, people are doing that, but an increase in demand in lumber, boom, it's pushing up those prices. And so we're seeing some significant surge prices in lumber and pressure treated products. And so good luck finding that stuff at the local Lowe's and Home Depot. Okay. I don't know if that answered all the questions there, but like trades, crafts, actually those industries are doing really, 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 really well. Okay.
All right, thank you, Tom.
Yeah, of course.
So another question here around, do you have any guesses about how the election will affect the economy? And will it depend on who gets elected?
So, and I can throw these. I don't know if I have this chart available here. So I looked at the S&P, just looking at the S&P, right? You look at the S&P of how the S&P usually rolls out after you get a new president. And there is zero significant difference with respect to the S&P for the first 100 days after a Republican president or after a Democratic president. I mean, there's zero significant difference. They're exactly the same. There is a little bit of difference with respect to the S&P for, let's say, a newly elected Democratic president versus a second-term Republican president. So the S&P is slightly higher for a newly elected Democratic president than for a second elected Republican president. But a lot of that is because if you average these out, I mean, George W. Bush did not have a very successful second term with respect to the stock market. And so, I mean, you average these things out and you say like, okay, so like one president's term can like push down the average for everybody else. Yeah, but that's the way the averages work, right? And so when you look at these things over time, we can't say that, okay, this president being elected versus that president elected is going to absolutely have a positive or negative effect on, let's say, the market, the S&P. But as I've pointed out in the past, and as lots of other economists have pointed out, the stock market is not the same as the economy. It's only one measure of, let's say, wealth or how the economy is doing. And a lot of people think that the stock market is still really overvalued. I think that the different presidential candidates right now have different agendas for how they're likely to treat the economy going forward, right? And so I think the current president does a lot of A/B testing. He tries this, that doesn't work, he tries that. He says this, it doesn't work, he says that. And if you read his books, if you listen to what he says, he's very comfortable changing his perspective at any given moment. Okay, not necessarily a bad thing for somebody who's running a real estate company, but it might be a bad thing if you're trying to put an economy back in order. What you want is a well thought out plan. Okay, so Steve Mnuchin, who's the Secretary of Treasury, it's a very, very smart dude, and he knows what he's doing. And right now I know he's negotiating with the Democrats in Congress to try to put together a fiscal stimulus package, okay? Because he knows that in order for us to have long-run growth, there has to be a stimulus package in place, right? And so, I mean, if Trump wins a second term and Steve Mnuchin stays on, which is very unlikely because there's usually a huge turnover after presidents get a second term in office. If he stayed on, he would probably have a really good idea about how to manage the economy going forward and at least put some practical policies in place. But it's not clear that he would stay on. I mean, most secretaries do not stay on for a second term. They just don't. And so I wouldn't count on Steve Mnuchin being around, right? If Biden is elected president, it's almost a certainty that he is going to tap into the same persons who were occupying lots of the seats during the Obama presidency, right? Biden was the vice president. They had policies in place. They had a very, very good long run trajectory, right? Very, very constant economic growth and a constant decrease in unemployment from, about, 2010 all the way through, right, 2017, okay, end of 2016. All right. And so it was very anemic. We were probably in a growth recession for 2010 and 2011, right? But it was a very, very, very constant growth, right? And so I could imagine that Biden would tap into those same resources. And then they would put a policy in place. And then what you're talking about is probably very low term, but long term regular growth. Here are the policies that will get us out of this, but it might take us 6 years to get us out of this. Now, I don't know if that's what you want to hear, but that's what I'm anticipating. Okay. So it's just really comes down to, I mean, if a president's elected, the president still, regardless of which president, the president still has to address the fact that we are in a awful economic recession. And we can't even start to address the economic recession until we have a vaccine for COVID. Because without the vaccine, kids are still studying at home. And so then you've got these added pressures on families, right? And as I showed you the statistics, considerable pressures on women to help their kids get educated. Well, that's taking away this huge resource that we have, which is going to put huge burdens on our economy. So in order to address that, right, either presidential candidate right now is going to have to figure out how to make that work. I anticipate if Trump is reelected, the policies they're going to change until they find something that they think works, right? And so that might be a little bit crazy, but I anticipate that he really wants to turn the economy back around, right? I mean, that's he holds that up as one of his primary accomplishments. And so I can't imagine that he's not going to want to address it, but I'm just not sure what that looks like because of the way that he goes about his decision making. Like I said, lots of A/B testing. Let's try this, and let's try this. Let's try this. Let's try this. I think Biden is going to be much more methodical and probably already has a plan in place, and it's going to look an awful lot like what they did during the Obama presidency.
Thanks, Tom. Well, actually related to that. So, I mean, what do you see being the impact on the economy if we can't have election results for a few months?
Yeah, think about 2001, right? 2000. So there was, the election came down to, a handful of votes in Florida, butterfly ballots and hanging Chad and all these things. And there was, a month of recounts and then Supreme Court case. And then eventually, the Supreme Court said, okay, well, the recount is done. And the point of the recount, George W. Bush was up by 500 and some votes, right? And so he won Florida by 500 votes, and he won the Electoral College by 1, and right, 271. So that was that, like the end. And so so everybody was on pins and needles about what that means and what that doesn't mean. That was 20 years ago. I think that we're dramatically different as a people than we were 20 years ago. I was just reading an article last night that said, look, the election has been contested many, 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 many times, and the United States has continued on, well, except for the one time when the South didn't agree that Abraham Lincoln was actually president, and then there was a civil war. But other than that, everything went great. And I was thinking, okay, except for this is a different, we're living in a different climate. And so I think that if we don't know who's elected on that Tuesday night or early Wednesday morning, I wouldn't be surprised. I also read just this week that people, their heads are probably going to explode because of who has identified they're going to mail in their ballots versus who are not. So something like 80% of Democrats say that they're going to mail in their ballots versus, let's say, 13 or 15% of Republicans. So on election night, I would fully anticipate that you're going to see Pennsylvania red, Michigan red, right? Florida's red, North Carolina's red, Illinois is red, like even states that should be blue, like Illinois, right? And you say like Illinois is going to be like on Tuesday night or Wednesday morning, Illinois is going to look red. There's going to be like a sea of red. And then as they start counting absentee ballots, all of a sudden everything's going to go from red to blue. And so 43% of the population, so this is essentially people who approve of Trump, that's Trump's approval rating right now, right? 43. Their heads are going to explode. They're going to say, what? We thought we just won Illinois, and you're telling us we didn't really win Illinois, right? So every vote has to be counted. That's the way democracy works. So their heads are going to explode. Who knows what that means then in terms of our economy? Are people just going to go nuts? Are they just not going to go to work? I don't think so. I think they're going to continue to go to work. I think that the economy is going to still continue to move forward, but I wouldn't be surprised if the stock market went completely crazy for a couple days. When you see like Illinois red, then it goes blue, and then people are like, "Why? What does that mean?" Right? You're like, Pennsylvania was red, and now it's blue, or now it's red again. I mean, who knows? Who knows how the stock market's going to react to that? But people are still going to make me coffee, and people are, still going to go to work and help people out at Emory Healthcare. So I don't think the economy is just going to come to a complete halt. I think people's heads are going to explode. They're just going to go crazy. But I don't think it's going to have a major impact on the economy. I think the economy is just going to move forward because we have no choice. We still have to feed our kids, right?
Another question for you, Tom, and just thank you to everyone for all of these incredibly thoughtful questions. What do you think the ripple effects will be on the rest of the world, and are there risks of deglobalization?
Well, there's absolutely risks of deglobalization. We've seen that now for the last 4 or 5 years. So there's sort of this idea of these nationalized policies are taking grips all over the place. So I think Brexit is a good example of deglobalization, right? I think what we're seeing in Brazil is a good example of deglobalization. And we're seeing in a lot of countries where you have the nationalist presidents who are being elected, or nationalist parliamentarians or what have you, who are being elected and saying, okay, what we really need to do is care about our country. And so we should put our country first. And so we've been seeing that take place for about the last 4 or 5 years. I don't think that what we're doing in the United States is a new experiment. It's part of that nationalist sort of trend rippling through the world. What a lot of economists have pointed out is that economic dependency, global trade, has had a positive impact with respect to wars and conflicts. You are much less likely to engage in a military conflict with a country that you have established a good trading relationship with. I mean, that's just been proven. What we need to do is we need to acknowledge that even though trade has negative effects on a particular industry, right? Like, think about when Trump was elected, he went up to Indiana to the Carrier plant and said, we're going to keep these jobs here. We're not going to we're not going to let these air conditioning jobs move to Mexico. And then a week later, they were in Mexico because it was in Carrier's best interest to have those jobs produced, or those air conditioners produced in Mexico, right? Made good sense for them. You can't tell Carrier not to do what's in the best interest of them. They're a private company. They're trying to make money. So if we have that kind of relationship, okay, so Carrier says, fine, you go make these in Mexico. Well, then we're relying on Mexico to produce products that we use in the United States. We don't want to go to war with Mexico, right? I mean, they help us make Fords, and they help us make air conditioners, and they provide us with all types of agricultural products, okay? And Mexico doesn't want to go to war with the United States because we provide them with all types of products. There's a reason for us wanting to be in good terms with each other, because economically, it's really beneficial for both of these countries to be engaging in the trade that they're engaging in. I think that, if Trump is reelected, I know that a lot of other, maybe European Union, will just sort of wave their hand to the United States and say, you guys you guys do your own thing. Clearly, you're not going to be engaging in sort of the world theater anymore. You're not going to take the lead there. And one of those countries will step into, let's say, the leadership role that the United States has occupied for many, 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 many years. So then that could be problematic. One article I read yesterday was that it might be very problematic that the United States is not engaging in the way from a world perspective on some of the vaccine efforts that are being taken place, engaged in on the world stage. And so they're saying, okay, like a lot of countries are saying, let's do this together. Let's figure out how it is that we can conquer this pandemic together. And the United States has stepped back from that. Well, it's not a good look if there's a vaccine that's available through a world stage, and then we have to walk up to them and say, yeah, we weren't really involved, but now we want to partake in the benefits. Well, we're going to have to get in line. So, I mean, there could be elements with respect to that. And then going forward, I promise you, this is not going to be the last pandemic, right? There's a Netflix special about this. I mean, people were anticipating this years and years and years ago. Everybody knew that this was happening, and everybody knew that this was going to be an economic shock. Just the question was, when is it going to be an economic shock? All right. And so there's going to be another one. There's going to be another, whatever it is, right? We saw the H1N1. We've seen this before. It's going to be another one. We've got to get ourselves in a position where we can tackle the next one, because there will be a next one. This isn't the solution. It's just, let's find a vaccine for COVID. It's, let's find a vaccine. Let's get a system in place for all of the pandemics that are ahead of us. I promise you, there's another one on the horizon. Go ahead. I'm sorry.
It's okay, Tom. So I think we probably have time for just one last question here. Sad to say that we're already coming to an end, but can you speak to any other key economic indicators besides unemployment? Average wages, mortgage payments on time, overdue.
Yeah. Well, no. Yeah. So, I mean, so I was mentioning some of those things here. Let me see if I can share my screen here with respect to this. I talked a lot about this the last time that we were out. There's a lot of interesting things that are happening with respect to the real estate industry, but also mortgage delinquencies and like defaulting on rents, right? And so all of the eviction moratoriums, they're all done, right? This is just a handful of states. So eviction moratoriums, there aren't any real eviction moratoriums anymore, right? So like Houston, Texas, they're evicting people, right? I mean, the courts are full of people that are in the process of being evicted. I just read about this yesterday. And there are very, very few protections in place, okay? Even the protections that still exist are really, really hard to like nail down, okay? What we're also seeing is huge rates of defaults. They haven't defaulted on mortgages yet because there's still most of the mortgage default protections are being put in place by individual banks, right? Your Fifth Thirds, your PNCs, your Chases, and what have you. And so you could get 3 months of let's say you didn't have to pay, and then you might get 3 additional months, and then you might start to work out a system. And so each of these banks are handling things slightly different, okay? But the trends are still very, very, very scary. Like here's the percentage of renters, this is say in Georgia, that haven't paid, okay? So we're seeing, let's say, going all the way through July, and these data come in a couple months in arrears. So it's going to be a while so I can update this. The percentage of renters that haven't paid is significantly high, right? It's upwards of 20%, and it continues to be upwards of 20%, right? And then the big risk here is for mortgage delinquencies, right, going from being current to being 30 days, right? And so currently those rates are about at 1% to 2%. In some areas like Miami, right, it's about 2% of mortgage holders, at least mortgages that you can see through Freddie Mac. So 2% of those mortgages are delinquent. Once you get into 30 days past due, the likelihood of moving from 30 days past due to 70 days past or to 60 days past due or more is huge. So once you're 30 days past due, then it's about 50% chance, right, that you're going to move from 30 days past due to about 60 days past due. And then if you're once you're 60 days past due, it's like 70% chance that you're going to move to like 90 days past due. And my colleagues Bill, as I'm working on these sort of migration analysis, looking at, going from current to 30 to 60 to 90, and it's if you can keep people current, you're in good shape. But once somebody goes into 30 days past due, it cascades, and the likelihood of getting even further and further and further behind is very, very, very high. This is a problem that has not been addressed. I know we've talked a lot about unemployment, right? I know that we talked a little bit about politics, but the fact that people can't make their mortgage payments and the fact that people can't pay their rent is still a problem that has not been addressed, okay? The executive order that the president signed last month did not actually address eviction moratoriums. He said, we'll do everything we can, but there's no power in that. You actually need a law that says, okay, you cannot evict your renters who haven't paid. So what's going to happen is that in the next couple of months now, Georgia and Texas and Florida and California, I mean, a whole bunch of renters are going to be evicted. And then it's up to individual people with respect to their mortgages to work with their banks going forward to make sure that that they're current, right? And that they don't get foreclosed on. And that is also another real problem that has not been addressed. So even though it looks like parts of the economy are coming back, I mean, unemployment rate's probably going to go from 10.2 down to 9.8 or 9.6, right? You're still having this huge number of people who can't make their rent payments and a huge number of people who can't make their mortgage payments. So not everything looks great. So that's a great way to end, right?
Yeah, right. Thank you so much, Tom. We really appreciate all your time today and for sharing all your valuable insights to us. As we wrap up today's session, we just want to thank Tom for his insights, inspiring kind of, perspective on what's happening in the economy. And thank you to our attendees. So many of you have joined us every Thursday. And for those who are new, thank you just for your questions and for engaging with us. We appreciate you taking the time out of your busy schedules every Thursday morning and spending time with us. So I want to share a couple of things with you before we officially wrap up. Next Thursday morning, Business Over Breakfast continues. As you can see, our focus on skills for a COVID world. So Professor of Organization and Management, Emily Bianchi, will be addressing psychological strategies used to manage uncertainty, lessons from past recessions. So that should be a really interesting and relevant topic. You can also see just the additional topics we have coming up for the rest of September. As always, a recording from today's session will become available on the Emory Executive Education LinkedIn page. So look out for that email and follow us on LinkedIn if you're not already. And then, of course, if you want more Tom Smith, who doesn't want more Tom Smith? We've got a personal financial fitness workshop coming up starting on October 2nd. As well as finance and accounting for non-financial managers in December. So we will share some links for that in the chat as well as in the follow-up email today. So beyond that, we'll have a brief survey pop up here on your screen momentarily just to get your feedback on today's session. It's really valuable to us. It'll only take 1 to 2 minutes, so we appreciate your feedback. And thank you again for joining us, and we look forward to seeing you next week. Have a great rest of your day.